So I was watching this video and it got me to dig into the strategy it was pitching. Let's watch the video first.
You take your entire paycheck, you deposit it into the home equity line of credit to pay down your mortgage. You then write all of the checks for your bills out of the home equity line of credit. You use money from your home equity line of credit to pay your mortgage, your electric bill, your blah, 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 all your other bills. You will pay off your mortgage, depending on how much money you make, in somewhere between 3 and 12 years instead of 30 years. Whatever you do, don't ever refinance a mortgage. Refining a mortgage to get a lower payment is a con job. They tell you, the bank tells you, the storyline they give you is that, well, you get a home equity line of credit to lower your payments. But you buy into that. But what they know that they're not telling you is when you refinance that mortgage, you restart the terms of the loan. So now it's a new 30 years, and the majority of the payments for at least the first 7 years goes to interest. So you're going to end up paying more at a lower interest rate with a lower payment on a refi than you would have ended up paying the bank if you had just kept on making the same old mortgage payment.
All right. So they're calling this a mortgage hack, and it's really not. It's more of a cash flow strategy. And let me explain how this works. The clip says you can pay off a 30-year mortgage in 3 to 12 years by running your paycheck through what's essentially a HELOC and paying bills out of it. And you use a home equity line of credit as a HELOC, by the way. It's just a line of credit pledged with your house as security. And they say to use it like it's your checking account. So let me break this down into something that's a little bit easier to comprehend. Most people know what a mortgage is. It's a loan secured by real estate, your home, that you pay off over a long period of time, usually 30 years. A HELOC is similar, but it's a line of credit. And you're only paying interest on the amount that you take out, and you pay back pretty much at any time. The only interest you pay is on the money you're actually using. So in a traditional mortgage, you would keep your checking account and savings account separate, and you would not pay down the mortgage. Like you would build up your savings account and your checking account. Because if you paid off a bunch of the mortgage, you couldn't get that money back, right? You'd have to go through a whole new refi or get a new loan. With velocity banking, you don't keep money necessarily in your checking and savings. I'm sure they're not saying get rid of those things, but you quite literally start to deposit your paycheck into your HELOC each month, paying it down. So you're no longer paying interest on that money. And then you use the line of credit, the HELOC itself, like it's your checking account. You pay your bills out of it. And that's called velocity banking by a lot of the folks that are out there that are kind of promoters of the strategy. Now, the big question is, does it work? Well, the product is legitimate. It's just a HELOC, home equity line of credit, and it's a real line of credit. And you can absolutely route your paychecks into it and pay bills out of it. The claim made in this video that it automatically turns a 30-year mortgage into a 3 to 12 years is exaggerated because the HELOC doesn't create savings, kind of out of thin air. The only thing that truly pays off a mortgage early is extra money going to principal. So if velocity banking works, it's usually because you're spending less than you earn. Pretty basic, right? You're using that money surplus to knock down the debt, the principal on that debt specifically. This is a system that tries to get you to apply extra cash to debt. A HELOC doesn't pay off your mortgage. Surplus cash pays off your mortgage. If you don't consistently spend less than you earn, nothing about depositing your paycheck into a line of credit makes your mortgage disappear faster. You're just moving the same money through a different pipe. Now, what's the truth inside the pitch? Well, 2 things are really true about this strategy. First, HELOC interest is typically calculated on a daily basis, right? So your HELOC is whatever your balance is. That's where you're paying interest. So if you dump your paycheck into the HELOC, you can reduce that balance for the part of the month that you would ordinarily be being charged interest, and you save some HELOC interest. That's 100% true. You're going to pay less interest if you're doing the strategy like he set out. Second, the strategy can actually act like a discipline system. For some people, it forces them to focus on cash flow and principal reduction. And those 2 things are true. But where's the catch? Let's go over kind of 4, I'll call them 4 dangers, and I'm going to just kind of list them up here. I'll just call them dangers. All right. Number one is the rate risk. HELOCs are usually variable rate. That means that your costs can rise unexpectedly. Interest goes up, interest also go down. A 30-year fixed mortgage is a little more stable, provided it's not variable. When you replace stable debt with variable debt, you're taking a little more risk. And most people do it without getting paid to take that risk. We're seeing this play out right now in the commercial credit market, where loans are coming due while rates have risen significantly over the past few years. Adjustable rate borrowers got smashed when the Fed raised rates. And so we saw rates more than double on mortgages from 2021 to 2023. And that could be devastating to somebody using the velocity banking strategy. Now, to be, again, 100% honest, it works both ways. Rates can drop as well. Like right now where I'm standing, we could see more interest rate drops, as they've kind of been doing that, right, the last year or two. But that's a risk you need to be aware of. Number two, credit line risk, and this is a big one. Credit line risk means this: the HELOC is not your checking account. Lenders can reduce that credit limit or freeze the entire credit line whenever they decide. So if you're living out of your HELOC and the bank tightens the line, now you have a problem. We saw this play out multiple times, most severely in 2008 to 2012, where banks routinely canceled, suspended, or limited access to HELOCs. All major banks, I'm talking about Bank of America, Citigroup, JP Morgan, Chase, Wells Fargo, actively reduced and closed thousands of HELOC accounts. What would you do if your paycheck was deposited into that line of credit and then the bank said, thanks, no more credit? Could you pay your bills? You need to be aware of this if you're using this strategy. Number three, it can turn normal living expenses into house collateralized debt. I'm just going to write house collateral. Oh, people don't think about this. In other words, this is not like a credit card where a lender has nothing to foreclose on. You could just bankrupt the debt like a credit card if you're way in over your head, and they eat it. No, when you're using this strategy, your groceries, utilities, all your spending is now backed by your home. It's secured by your house. If your cash flow gets disrupted, you're not just laid on a card now, you're laid on a lien that is tied to your house. Number four, the whole thing about the refi as a con job, no. Refi, not a con. Let's be real, guys. Come on. That sounds good on social media. But I just think it's way too absolute. What he's describing is real about refinances. If you refinance into a new 30-year term and just enjoy the lower payment, you extend the debt and you pay more interest over time. But refinancing itself isn't a scam. It's a tool. You can refinance into a shorter term, or refinance and keep paying the old payment, pay it down faster, or refinance to lower the rate and still attack principal. You don't need a HELOC just to do that. The con is refinancing and then spending the savings while resetting the clock. And here's another big one people miss. A mortgage has what people call front-loaded interest because it amortizes. And this is what he was talking about. Early payments are mostly interest because the balance is highest early. So yes, you're refinancing. You're not getting ahead in a way you might think. You're really just running in place. But a HELOC is not front-loaded in the same way. It's simple interest or based on the balance over time. If you don't pay down that principal with the HELOC, it doesn't magically flip in your favor. So here's my bottom line verdict. This strategy can work for a very specific person. Someone with stable income, surplus cash flow, high discipline, and a clear plan to pay down principal aggressively. But for a lot of people, velocity banking is a spreadsheet trick that hides the real driver that makes the strategy work. Spending less than you make and paying down principal, with an added caveat, and that's the dangers here, right? It adds risk. Variable lines, these possible freezes, that ever kind of present temptation to just keep that big balance rolling, and you secured it with your house. Velocity Banking is using a HELOC like a checking account to try to pay off a mortgage faster, but the real driver is still having extra money every month. And God, it adds risk because HELOCs can change. You get to the same place without the risk by simply paying down your principal on a mortgage. For example, let's just say keep a kind of a 1 month buffer in a high yield savings account, and then deposit your paycheck into your checking and pay your bills. Sweep anything extra directly to principal on your mortgage. Boom. You're doing almost the same thing. You're making money on the money that's put aside, which is great, and you're paying a little bit of interest, but you're paying it down aggressively. Other options: save up in a high interest savings, again, a high yield savings, or a money market account, and once in a while pay a lump sum. Usually there's a minimum amount that can qualify for what I'm going to describe here. But you pay a lump sum towards the interest, and you recast the loan. Now, not all lenders allow this, but it's worth checking out with your lender, because what it does is it allows you to pay a lot less interest, and you'll pay that loan off a lot faster. Other things that people have suggested, and you get this from folks all over the place, you can kind of go on the internet and go down the rabbit hole, but maybe you're paying biweekly instead of one time a month. And this is kind of doing that same thing where you're paying off interest a little bit earlier, and you're also making an extra payment per year. And this allows you, by the way, if you did this, because you think about it, you're making, instead of just once a month, you're going to be making, because it's 52 weeks in the year, you're going to be making an extra payment. And this allows you to pay your loan down and pay it off, actually, generally speaking, between 4 to 6 years faster than making normal monthly payments. My personal belief is that you simply pay a consistent percentage of your income towards paying down the mortgage on your, or the principal on your mortgage. So it might be like, in my world, I use this 70-30 rule, and I'm taking 10% and I'm paying down debts. I would just be paying down this as one of those debts. But you're also, in my world, taking 10% of your income and you're putting it into cash flow assets like stocks, REITs, and investment real estate. You can do both. You don't need shtick or gimmicks to do it. And by the way, because I know the Velocity strategy folks are going to be out there in the comments, please let me know if I'm wrong in what you disagree with. And if I missed anything, just let us know in the comments. It helps other people to see the thought process. And by the way, for more tips from a tax attorney, like and subscribe.